This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital, and Mark McGrath, associate portfolio manager at PWL Capital.
Well done, Ben, and welcome to episode 304. The band is back together again today, and we've got a pretty hot topic, I think it's safe to say, guys, with the recent announcement by the federal government of Canada for some proposed changes to the capital gains inclusion rate, how much tax people pay on capital gains. And this has been super hot, which we'll talk about in the Aftershow, because it was a pretty wild week on Twitter and other sources of media in Canada for you guys. But that's the main focus of today's podcast. Anything you want to add to that?
Yeah, no, I think it's going to be, obviously it's topical. It's something that I think people have been anticipating in some respects at different points in their careers. I know as advisors,
speculated for years, right? Every year it comes up, right? Oh, it's time to raise the inclusion rate.
Yep. And I know advisors who have made changes to client portfolio, not here, but like in my old world, they made changes to client portfolios in anticipation of this, which in hindsight wasn't the right idea. But you're playing this kind of chicken and egg game, trying to get ahead of it. So I think today we'll break down how capital gains works, how the new proposed inclusion rates work for both individuals and corporations. Ben's going to talk a bit about alternative minimum tax, or AMT, which is another proposed change in the budget that has some pretty significant impacts in certain cases. And I know Ben has been doing a ton of modeling on these new proposed inclusion rates. And like the big decision for a lot of people is, do they trigger capital gains now to get ahead of this change, and what are the impacts? And the answer is not always cut and dry. So I know Ben's been doing a lot of work on that. So if people have questions about that with respect to their own financial plan, obviously they can reach out to us.
That's also the interesting part, right? It's interesting to dig into the decision points before you make a rash decision based on what the headline story might be.
Totally.
So, yeah.
We've been spending, like Mark said, a ton of time modeling this. I've spent more time writing Visual Basic code than I've probably ever in my even. I don't usually use Visual Basic that much, but I have a tax function that I have written in Visual Basic that I used to do different types of modeling, and because of this change, I've had to rejig that tax code, and it's been difficult because of the way that all this stuff interacts with different parts of how taxes are calculated. So that's been lots of fun. But yeah, like Mark said, we've spent a lot of time modeling it, and we've got our clients queued up for who needs to be contacted for what, like who's it's going to be relevant for, and what we're going to advise them to do. But if anybody who's not a client has questions about their situation, feel free to reach out.
And Ben, you made a publicly available calculator for personal capital gains taxes, not for corporations at this point, but for personal capital gains, where people can go for free and model their own scenario and get some insights.
Yep, that one is up online. It's by the time this episode comes out, I'm hoping we'll have alternative minimum tax in there. In the initial release, we did not include that, and as we'll talk about later in the episode, that could be very important for some specific cases.
Yep. All right, guys, good to roll?
Let's go ahead to the episode.
All right, guys, let's get going. Episode 304, increased capital gains tax, hot topic.
Yep. So as we said in the introduction, federal budget in Canada, and I do want to say before we get into it, yes, this is very Canadian content, but I think it's interesting for anybody to listen to, because there's a lot of interesting decision-making concepts in here, and we've done some cool modeling, and cool modeling is always fun for anybody anywhere. I talked to somebody about this morning on the day that we're recording this, who is not in Canada, and we were talking about other stuff, and he asked about the budget, and I started talking about it. And I realized, like, you're not from Canada, like, you don't care about this. And he's like, no, this is super interesting. Please keep going. So anyway, all that to say, if you're not Canadian and this does not affect you directly, you may still find the discussion interesting. So,
well, and in the U.S., there was a recent proposal to change capital gains on, I think they're income testing it, or at least scaling it in based on income levels. So while obviously that's not a complete analog to what's going on in Canada, our American listeners are dealing with decisions around capital gains as well. So to your point, Ben, I think some of your thought processes that you're going to discuss might be relevant in some cases, at least how to approach the decisions.
Yeah, very good point. I'm always just wary of our global audience when we're talking about such a Canada-specific topic, but I think it's going to be interesting for anybody. Okay, anyway, so Canada's federal budget recently proposed an increase in the capital gains tax rate, and we'll talk about the way that they did that, the mechanism they used in a second. But what that means is that when you're selling a taxable asset like a business or a secondary real estate property, in Canada we have a primary real estate tax exemption. So if you sell your primary residence, you don't pay tax, but a secondary property, you would pay tax, or a taxable investment portfolio. You sell that for more than you put into it. That's a capital gain. You pay tax on that. They're proposing to increase the rate on that. One interesting piece about this is that in the proposed change, it would not take effect until June 25th. So any gain realized before June 25th will be taxed at the old lower rates. And so that is what opens the door to all of the analysis that we've been doing. Like, people have between now and then, potentially, because it still hasn't passed in a law, but assuming it does, between now and June 3rd, I guess, if you take settlement into account, to do stuff. But that, like you said, Cameron, people could make a lot of mistakes too, because if people run out and sell their assets now because they're worried about this, one, it's not passing a law, so it could just go away, which that would be a whoops. But also, even if it does pass in a law, there are a lot of cases that we'll talk about where it actually would not make sense to sell an asset now and pay tax at the lower rates. Anyway, so we'll get more into that in a sec.
Well, not all assets can even be sold on that short of a timeline, right? Like, depending on,
True.
I mean, even like secondary properties, rental properties, vacation properties, like that just all depends on what the market's doing.
Anything can sell for the right price. So if people are really worried, they might, you know what I mean? Sell their cottage for way under market.
You see some headlines of people rushing out to sell their cottage properties. I'm like, you're likely going to take a bigger haircut on the price, perhaps, if you have to make a market.
I saw that headline, but the sources were all realtors. I'm always skeptical about
exactly.
Yeah. But like a business, for example, or even some investments just aren't liquid. They have liquidity windows, like only quarterly redemptions or annual redemptions. So it's like the portfolios we're talking about are generally, like you said, 2-day settlement, right? We click a couple buttons and it's sold. But there are others who have illiquid property that they don't have the luxury of being able to click a couple times and make that decision.
Yeah. Can you talk a little bit more about what a capital gain is, Mark, just before we keep going, so people are on the same page?
Yeah. Yeah, and you mentioned the rates are going up, and so it's like the tax rates are not necessarily changing. What's changing is the amount of the capital gain that gets included in your income. So traditionally, when you have a capital gain, so you buy something for X and you sell it for more than X, the difference in value between your cost and the market value or the sale value of that asset, traditionally only half of that gain would be included in your income for tax purposes. The other half you stick in your jeans tax-free, right? So if you have a $100,000 gross capital gain, half of it, $50,000, goes on your income tax return as income and is taxed at, essentially your marginal rates or effective rates. The other half is tax-free. Yeah. The proposed changes, with certain limitations, would increase the inclusion rate. So instead of including half of the capital gain in your income, you would include 2/3 of it in your income. It's still going to be taxed as income at your marginal rate, but the amount of the capital gain that you include is potentially going to go up. Now, you're going to talk about this, I know, but for individuals, they've put a $250,000 annual threshold. So under $250,000 of annual capital gains, you can still avail yourself of the 50% inclusion rate, basically the old rules. It's only on the dollars above that $250,000 threshold where they're talking about increasing the inclusion. However, for corporations and trusts that retain capital gains income, there is no threshold. So if you have a small business corporation, I was on Twitter talking to professionals and doctors last week, but for them, there's no $250,000 threshold. So the proposed changes are such that inside a corporation, if you have a corporate investment portfolio of whatever stocks, bonds, ETFs, every dollar of capital gains inside the corporation would be subject to this new higher inclusion rate. So that's how it works, and that's the proposed changes.
Yeah, that personal versus corporate thing / trust thing is super important, because it's you know what, I'm not even going to continue making comments on that. Maybe we can come back to that later.
Okay.
That's the part that gets very contentious. Who should get the $250,000 of?
No.
Anyway, we'll leave that alone for now. Okay, so a little bit of history, and yes, this is Canadian, but trust me, it'll still be interesting. So capital gains in Canada were not taxed at all prior to 1972. I found some really interesting historical research on this, detailing historical Canadian tax rates. Since 1972, the top combined federal and provincial capital gains tax rate for individuals in Ontario, and that's just the data I was able to find, and this is accounting for the inclusion rate that Mark was talking about. So this is the top tax rate multiplied by the capital gains inclusion rate in that year. So it's been as high as 39%. That was in the 1990s, and as low as 23% in the 2000s. So that means you're paying 39% of your capital gain in the 90s, 23% in the 2000s. This budget proposal, by increasing the inclusion rate, like Mark was talking about, from 50% to 2/3 to 67%, it would increase the overall top tax rate in Ontario on a capital gain to a little more than 35%. So pretty close to the highest it's ever been at the highest rate in Ontario. Most of that variation historically is due to changes in the inclusion rate, not due to changes in tax rates. So similar to what we're seeing now, tax rates aren't changing, but the inclusion rate is changing. So that it causes historically there's quite a bit of volatility in the capital gains tax rate, and it's largely due to the inclusion rate. So that's kind of interesting. The current inclusion rate, like we've mentioned, has been 50% since 2000. It was 75% from 1990 through 1999, 66%, close to what it's going to be proposed to be now, in 1988 and 89, and then it was 50% before that since 1972 when it was initially put into place. So yeah, that's kind of where we're at now. The corporation piece, as we've mentioned, is really important. So if I look at, instead of the highest personal rate being 35% in Ontario, I won't explain the full mechanism, and it's pretty complex and it depends on a lot of different assumptions. But if we just assume somebody owns a corporation, they have an asset inside of their corporation that they sell for a gain, a capital gain, and they immediately distribute the proceeds, the after-tax corporate proceeds, to a shareholder. So we've got two layers of tax here. We've got corporate tax, we've got personal tax. We're assuming that they're paying that personal tax immediately, which would not always be the case, because in a corporation you could realize the gain inside the corporation and not flow it out personally to pay the personal tax. Anyway, it's probably getting too deep in the weeds there on corporate tax, but the top rate under this change would be 38.6% for somebody, call it whatever, 39% almost, for realizing a gain in a corporation and flowing it through to a shareholder. Previously, it was about 29%. So corporations, they don't get that $250,000 exemption for the old inclusion rate, and the overall rate that they're paying is a decent chunk more than an individual earning a capital gain.
And that's in Ontario, right? Like different provinces, the math will be slightly different.
Correct. Yeah, those are all Ontario numbers for both the corporation and the individual. A lot of individuals will probably be protected by the $250,000 limit.
Yeah.
How many? What proportion of people? That's another very contentious point, because in the budget documents they claimed it's a tiny fraction of people that will be affected by this change because of that exemption. To the extent that that's true, that's great, but my judgment is that a lot more people than were indicated by the stat in the budget document will be affected by this. Because like anyone that has, and I know we have biased samples because we talk to people who have money generally, because that's who's interested in what we have to say and that's who our clients are. But a lot of people have secondary properties or taxable investment portfolios with gains above $250,000. So I mean, it'll touch a lot of people.
Well, and I think on that point,
that's a bad thing.
Yeah, and agree. Without getting political about whether this is good or bad, I think my concern was that the way that the budget was presented, what they did in order to determine how many people were going to be impacted by this, or how many corporations were going to be impacted by this, they looked at a single year, and they said how many corporations had a realized capital gain in this single year, and the number I think was 307,000. So it was a very, very small number. When there's over I think there's around 1.2 small businesses registered in the country, so it wasn't a huge number. The problem with doing it that way, in my opinion, is 2022 was not a great year for assets.
Right.
So you had stocks were down, real estate was down, bonds were down. So people may have, like behaviorally, many people may have just not triggered gains or losses in their corporation because it was not necessarily a good year to do that. Maybe many had losses instead of gains. But also, to your point, Ben, that doesn't capture the unrealized capital gain that everybody else has on all of these assets. So a single year's data, to me, isn't a good way to look at this, because anybody who has an unrealized capital gain in a corporation is affected. Anybody with perhaps a secondary property, a vacation property, a cottage, a cabin, is going to be affected. And every estate, when somebody passes away in Canada, there's a deemed disposition on all of those assets. And so many estates are going to be captured by this as well. And none of that was clear from the way that the budget was presented.
Yeah, that's a big one. That when you die, the second one, on the death of a second spouse, typically, because you can do a tax-free rollover on the death of the first spouse most of the time, death of the second spouse, all of your taxable assets are there's usually a deemed disposition.
That's right.
On death. So even if someone's deferred gains for their whole life, then in the year of death, they'll tend to have a large capital gain. And again, maybe that's great. Maybe that's a good thing because it'll raise tax revenue and it'll on wealth transfer. And maybe I'm not saying that's a bad thing. That's just what it is. That's what'll happen.
Yeah, we're not tax policy wonks here.
Yeah, and I don't want people to get upset with us for our opinions on tax. I'm trying not to have opinions, just saying what's happening. One interesting point that I found going through the budget supplement was that employee stock options are also affected by these proposed changes. So if you have qualified employee stock options in Canada, they previously received a stock option deduction for half of the stock option benefit. And that's proposed to be decreased to 1/3 for amounts over $250,000. So it's very similar to capital gains. One interesting point on that is that the $250,000 limit to get taxed at the old rates is shared by stock option income and capital gains income. I just thought that was an interesting point. So,
well, I think that's quite important, right? Like, because depending on the sector you work in, like a lot of technology companies, part of the compensation they offer their clients or their employees is stock options, right?
Yeah.
And so they don't have the benefit of having separate, like now their compensation is potentially wrapped up in the capital gains changes. And I'm not sure that was the intention, or at least when people are thinking about the $250,000 threshold, they're thinking about assets that have appreciated in value from just sitting on them. But now we're getting into potentially compensation being affected too. Yep,
I agree. We work with a lot of people in technology who have stock option income, and yeah, for sure, this will affect them on both levels. So the big question, and we kind of talked about this in the introduction. The big question everybody is wondering about is, what should they do? So we've got these proposed tax changes, and even though this is something people have talked about for as long as I've been in this business, that the capital gains rate's going to increase, it's actually been proposed now. We've never gotten this far before. So we still don't know if it'll go through and be passed in a law, but this is as close as we've ever come to that change happening. And we have this time limit until before June 25th to do something. So people are wondering, as they should be, what they should do. So I'll just go through a quick example. If an individual has a taxable asset worth $1.1 million with an adjusted cost base of $100,000, and they have that's a $1 million capital gain. And say it's like an investment portfolio, it could be a cottage or rental property or whatever, some taxable asset. Paying the capital gains tax on that asset prior to June 25th would result in about $268,000 of tax at the top rate in Ontario. So that means we're assuming there's $1 million capital gain, and this person also has other income that pushes them to the top rate. So before June 25th at the old 50% inclusion, that's a $268,000 tax bill. After June 25th, so same tax year, they sell the same asset on June 25th, I guess they sell it because it's on or after. They would owe $335,000 in tax as opposed to $268,000. So it's a big jump for sure, but it's not obvious still, as we've alluded to a couple of times, that everyone should just be selling their assets before June 25th. It does lower the tax bill today, but it also means that you have to pay that tax bill today, not literally today, but next April when you file your taxes for 2024. If you're planning on selling an asset soon anyway, sure, sell it on June 23rd instead of June 26th. If you're planning on selling it this calendar year, say, or if you're planning on selling it in June, it's better to do it on 23rd than 26th. But if you were not planning on selling the asset in the near term, it's a lot less obvious that hurrying up to sell it makes sense. It can still make sense in some cases, but it's just not as obvious. The reason is that deferring that tax bill into the future, even knowing that there's going to be a higher inclusion rate in the future, can still make sense because there's an opportunity cost to paying that tax bill now as opposed to deferring it far into the future. And the opportunity cost is going to be a function of your expected returns. So it depends what the money's invested in or what the tax bill, the money that you pay the tax bill with would be invested in, I guess. And it's going to depend on your tax rate as well. So this is what we've been feverishly modeling for both individuals and corporations since this news came out. And yeah, it's been interesting. The way that we've set up our modeling is with a break-even number of years. So it's like you're better off deferring the gain rather than realizing it immediately at this number of years. I don't know if break-even is the right description, but anyway. So back to the example of the $1 million capital gain, assuming 100% equity expected return, the break-even's like 7 or 8 years, depending on a couple of other assumptions that you can make. So that means that if you're planning on holding the asset for 7 years or 8 years or whatever it is, or longer, then you would actually rather continue holding the asset and not prepay the tax at the current lower rate. So that was an interesting finding. Do you guys have anything to add before I keep going?
No, and like you said, it's going to be a function of the assumptions you use on the returns, right? And obviously we don't know what tax rates are going to be in the future. We don't know what inclusion rates are going to be in the future either. So the trade-off is, I think, and you've pointed this out in different topics before, Ben, but there's some tax certainty as well.
True.
That can be considered, right? Because if you sell today, you at least know what the rates are today and what the inclusion rate is today. But if you run this modeling and it says, yeah, you got to hold off for 7 years, there is some tax risk there too. Like what if the inclusion rate goes up to 100% by then, right? Or top marginal tax rates have, or it could go back down. That's it. So we don't know. So there is a trade-off between certainty and uncertainty, despite what the math says. But I think it's really fascinating that paying more tax later can still be, better than paying less tax today. And it's just a function of those assumptions that you're going to use, right?
Yeah, it's really just the opportunity cost, which is a function of your future tax rate and your expected return, I think.
Yep.
So far we've ignored AMT, and people might be wondering what that means. A lot of people might be, because I posted about this on Twitter, and there were a few people that said, like, I've been interested in tax and investing for years, and I had no idea that there was an alternative minimum tax in Canada. AMT means alternative minimum tax. Now, in the examples that we talked through a minute ago, we assumed the highest marginal rate in Ontario, which means that the person had other sources of income, a large amount of other sources of income, and then they had this large capital gain. Usually AMT is not going to come into play there. Where AMT is going to matter a lot is if someone has low or no sources of other income and a large capital gain. And I'll explain why that's true in a second. So personal tax returns in Canada have two parallel tax calculations. So they run side by side. There's the regular tax calculation and the AMT calculation. If AMT exceeds regular tax, you pay AMT. And the calculation for AMT is actually pretty simple. There's an adjusted taxable income calculation. The adjustments are, that's why I said relatively simple, because the adjustments are a little bit complicated. Then you subtract a basic exemption, and the budget has proposed a change in that as well, so we'll talk about that. And then you apply the AMT rate. So you calculate your adjusted income, subtract an exemption, multiply by the AMT rate. If that number exceeds your regular federal tax bill, you pay AMT. And the mechanism is really like, however much AMT exceeds your federal tax bill by, the excess is AMT that gets added to your tax bill.
Yep.
Budgets 2023 and 2024 have both proposed changes to AMT. The 2023 proposals have not become law yet. So the 2024 proposals are also changing some of those 2023 proposals. It's very confusing, honestly, in terms of like what's been actually passed in the law and what hasn't.
Mm-hmm. But as of today, there's
yeah.
been no change to AMT for quite some time, right? So as you mentioned, 2023, they
Correct.
proposed some changes. Nothing happened. The new budget
Correct.
makes changes to the 2023 proposals. But as of
Correct.
today, of recording this on May 1st, there hasn't been there's no difference in AMT today versus, say, 3 or 4 years ago.
Correct.
Okay.
The tricky thing is that these changes are proposed to happen, now. So if they get passed in the law at the same time as these, as the capital gains inclusion stuff that we've been talking about, it'll have some pretty interesting interactions potentially. Okay, so what were the changes? The basic exemption. So remember, you calculate your adjusted income, subtract the exemption, multiply by the AMT rate. The basic exemption is currently, as the current law is, $40,000. So you subtract $40,000 from your adjusted income to find your AMT bill. That is proposed to increase to $173,000 and some change. So that's, again, probably good for people with lower incomes. Not so good for people or lower amounts of adjusted income, I guess.
Is that exemption indexed to CPI, to inflation?
I'm not sure about that. I don't think the 40,000 is.
No, it doesn't seem like just looking at the number, like it seems like a flat rate, but I'd have to look this up, but I believe the 173 was supposed to approximate like this.
Okay. So
one of the top tax brackets, like not the actual top, but maybe the second from the top tax bracket.
Yeah.
Like that's where that threshold comes from. And I believe that is indexed. So I could be wrong. And we talked about this before the show, but just seeing the numbers, I'm curious.
Yeah, well, I think the budget said 173 in 2023, and the number I'm seeing now is 173,205. So that does suggest that there's some indexing going on there.
Okay.
There were also changes to adjusted taxable income. So that calculation for what are you actually getting charged AMT on, there's some changes to that I'll talk about in a second. And then a big one is that the AMT rate has increased from 15% to 20.5%. So again, if you have a lower amount of adjusted income, if that exemption goes up, great. But if you exceed it and have to pay AMT, the rate has gone up. So it's more penalizing, but there's also a higher threshold to actually hit AMT. In terms of capital gains, the reason that this is all relevant is that one of the proposals to adjust the taxable income is that capital gains would be included at 100%. So remember, for regular tax, it's currently 50%, proposed to go to 67%. But for the AMT calculation, you include 100% of your capital gain income. So that's a big one. Other stuff like deductions are reduced. So common deductions like employment expenses, childcare expenses, carrying charges, which is like interest and investment fees, those are all included at 50%. So on your regular income, you can deduct those. On the AMT calculation, you can only deduct 50%. The donation tax credit is proposed to be included at 80%. So again, you lose some of that deduction. There's lots of funky stuff in there. Like you can find some pretty interesting scenarios where AMT would be relevant, but we'll just focus on capital gains because that's what we're talking about. So if you have no other income, and remember earlier we used an example where somebody had some other source of a high amount of income. In this case, we're assuming no other income source, and they realize a $2 million capital gain personally before June 25th. Regular taxes would be about $304,000, federal taxes. And we'll talk about the provincial side in a second. So $304,000 of regular tax. The federal AMT would be about $374,000. So the difference is what you'd pay as the AMT tax. You've got $304,000 of regular tax, and then you've got to add on $70,000 of AMT because the AMT calculation says the minimum tax is $374,000. So that's that. And then there's also provincial AMT. And the way that's calculated is generally just a set percentage of federal AMT. So for BC, for example, AMT is 33.7% of the federal AMT. So of the $70,000 in that previous example. Ontario drives me nuts with the surtax. Ontario's tax calculation is crazy.
Let it out, Ben. Let it out.
It's honestly like modeling it is just not fun. But instead of just doing a fixed percentage, it's like there's a percentage, like it's 33.67% for Ontario, but then they also charge surtax on the AMT, and it makes the whole calculation for Ontario tax super confusing. And then Quebec has a separate AMT calculation altogether. So they do it as a... Yep.
Didn't you open this by saying calculating AMT is relatively simple?
Generally.
Because this
provinces?
is not simple to me. Like I wrote an article on AMT last year or whatever, and when I was researching it, I was like, this is quite and a lot of the difficulty comes from the things you've mentioned, which is one, the provincial taxes are all different. In most provinces, it's actually not that difficult because it's just a percentage of the federal AMT, but more so the deductions and how they're excluded or included in the AMT calculation. So to actually calculate it for yourself, you'd have to see all the deductions that you've taken on your tax return and then apply different percentages to many of these deductions to calculate the AMT. So as a concept, I think it's relatively simple, but to actually calculate your own, AMT is not necessarily that easy.
God, is the AMT stealing the capital gain thunder here in this episode?
I think it's
super important.
Yeah, absolutely.
Yeah. But you'll hear why in a second, why it's important specifically to capital gains. Like we're not just going off on an AMT tangent here. There's this comes back to capital gains in a very...
That's my point. Like it's very rare that you dig into details on AMT like this.
Mm-hmm.
Yeah. So I didn't put this in my Twitter thread, but I almost did, and I just ended up taking it out because I didn't like it. But I wrote that AMT is having a moment. And it's like in this specific case right now, AMT is super relevant. Usually it's whatever, somewhat obscure, but because there's this incentive to realize capital gains before June 25th, and because of the proposed changes to AMT for the next couple of months, whatever it is, not even, is going to be super important for people to understand.
You seeing that Twitter post was too clickbaity?
I don't know. I just didn't.
I loved it when you sent me the thread before you posted it.
It's funny.
That was my favorite part of the thread. I'm kind of upset you took it out, but
I should
whatever.
have taken it out.
I
reread that thread so many times, and like,
that's good.
I don't know. It's one of those ones where I spent more time on it than I got engagement. Sometimes you write like this, I think a useless tweet, and it gets like so much engagement, then you spend hours researching something, and nobody cares.
Yeah,
that's how it goes. Okay, so for provincial AMT, so in our example with the $2 million, we've got $70,000 of federal AMT. The provincial amount is going to correspond to that somewhat. So in Alberta, just a couple of examples. In Alberta, that would end up being $24,500 roughly on $70,000. So $70,000 of federal AMT equals $24,500 of Alberta AMT. BC would be $23,500 roughly. Newfoundland $40,500, and Ontario $37,000, including the regular AMT plus the surtax on the AMT. So it really starts to add up. Like so now we're at somewhere around
though.
Between the provincial AMTs.
Well, Newfoundland compared to BC is almost double in this example.
Yeah, so Newfoundland's one of the highest ones. That's why I put it in there, as I think it is the highest. That's why I have it in my examples. BC might be the lowest. I can't remember. I have them all written down, but anyway, and so those differences matter a ton, and I'll come back to that in a second. But in any case, we're at like $100,000, maybe a little below or a bit above $100,000 of AMT. So that's additional minimum tax that you're paying on your bill, on your tax bill. So on that $2 million capital gain, regular federal and provincial taxes would be about $493,000. And then if we take that's in Ontario, sorry. And then if we take AMT, that's another in Ontario, that's another $107,000. So someone planning to realize a capital gain, $2 million capital gain, and assuming a $493,000 tax bill, that would be a big whoops to realize, there's another $107,000 of taxes owing. Would be quite a nasty surprise. One important detail about AMT is that it can be recovered. So you can carry forward AMT for up to 7 years, and you can use it to offset regular income that exceeds regular taxes that exceed AMT. So if you have AMT in future years, you can't carry forward your AMT. It just keeps building up. But if you have regular taxes above AMT in future years, you can soak up your AMT carry forward using those taxes. So if you have an excess, a regular tax bill in a future year, you can carry forward some of that AMT to reduce the taxes that you have owing. So you can kind of go back and mop up. It's effectively a prepayment of taxes in that case where you're actually able to go up and recover it. But there are a bunch of cases where it's not recoverable, in which case it's not a prepayment of tax, it's just a straight up extra tax. So those cases where it's not recoverable become super important, again, in this specific time period where AMT is going to be very relevant to capital gains. So one case is if there are no future years with high income within 7 years. So if you have a big $2 million capital gain now and no expectation of higher income years in the future, because remember in our $2 million capital gain example, there's no other income sources in that year, there's a good chance you won't recover all of your AMT. If you're invested in a portfolio of like stocks and bonds that's earning some income, you're at least based on my modeling, you'll recover some of your AMT, but probably not all of it, unless you have other sources of income. So that's one. And if it's a cottage, like if it's not an income producing asset that you're selling, then that wouldn't generate income like a portfolio would. So that would be even worse in that case. So that's a loss of AMT. Another one is provinces. So Mark, you mentioned earlier, there's a big difference between some of the provinces. Provincial AMT is recovered, again, as a proportion of federal AMT, but based on your current province of residence. So if you have AMT in a high rate province and then move to a low rate province, when you recover it, you lose that difference between the two provincial AMTs. Now, the same is true, like you could do some fun planning with this too. It's true in the other direction as well. So if you have AMT in a low rate province and then go recover it in a high rate province, there's a positive delta there.
So you got to move from BC to Newfoundland to get your taxes back and then move back if you so choose.
I mean, if the AMT numbers are big enough, like if it's a huge gain, maybe somebody would do it. I don't know.
People leave the country over taxes. I mean, switching provinces isn't a big deal in the grand scheme of things, right?
Yeah, so that's actually another point on AMT is if you have AMT and then leave Canada, that's it, because you're not going to have any future regular taxes in Canada to mop up the AMT. Another one is Quebec. If you have AMT outside of Quebec and then move into Quebec because they have a completely separate provincial AMT calculation, you lose your provincial carry forward in that case. So these are all just points where it's like, I think it highlights why it's going to be important for people to understand AMT if they're going to be thinking about realizing large capital gains this year, because it ties into all your other plans. Like, where do you live now? Where do you expect to be living in the future? I talked to somebody recently who has a large capital gain in Canada, and they wanted to know about this, should I realize the capital gain, but they're planning on moving to a different country permanently in 2025. So in that case, they have a low income this year, so they would pay the AMT, but then they'd be gone, and that's it. So they're effectively just paying capital gains tax at a much higher rate if they do that. And
so that'd be true on exit, or what we call exit tax as well, right? Like when you become a non-resident of Canada for tax purposes, you are deemed to have disposed of your assets for tax purposes, right? So if you have a large capital gain and you are becoming a non-resident, it's the act of leaving can trigger the capital gain, but now you have no way of recovering it, right? So exit tax, I guess, could in theory be a lot higher because you can't recover the AMT if you're leaving.
Yeah, it's a really interesting point. I think that I don't know why it would be different on exit tax, but assuming that is correct, that is a very good point for anyone saying, I'm out of here, Canada's increasing the gains, but I'm leaving. Well,
gotcha.
Yeah, that's seriously. So we talked about the break-even numbers earlier. There's 7 or 8 years that we kind of found in that example as a break-even. The AMT, I won't throw a number out there because it varies a ton based on the assumptions, but AMT really changes this math, especially if it's someone who has low other sources of income. Like in the example we've been talking about with the $2 million gain and no other sources of income, because they won't mop up that AMT, it really messes up the break-even calculation to the point where it's like it's pretty unlikely that you'd actually want to sell the asset.
And sorry to be clear, Ben, all of this math that you've just walked us through is before any of the budget changes. So it's using the 50% inclusion rate on capital gains as well as the current AMT rules, right?
Yeah. So once the gains rate, the gains inclusion rate, or if the gains inclusion rate increases to 2/3, as is proposed, the AMT on capital gains specifically, you could still make AMT appear, but on, like in this example for the $2 million example, AMT is lower than regular taxes at a 2/3 inclusion rate.
Oh,
So
interesting.
yeah, that's why, again, like AMT is having a moment. It's this specific set of circumstances right now that make AMT particularly important.
So the lower your income, the less concerned you are with, in general, with the proposed tax changes.
Well, yeah, I mean, in general, that's true, especially if you're not going to realize capital gains.
So if you're realizing a big capital gain because of the AMT calculation.
Well, if your income is lower, I mean, you'll still pay less tax overall, I guess, if you have a lower income, but that's when AMT will be triggered. If you have low other sources of income and a large capital gain, that's when your AMT tax is going to exceed your regular tax. If you have a higher income, your regular tax is going to be higher overall, so AMT is not going to be an issue.
And this is calculated based on, like, let's say this gets implemented, the budget, and you do sell all these assets today. The AMT calculation that you would actually use for the 2024 tax year, do you know if it would be the new AMT rules or the old ones? Like, because you're triggering the gain prior to the AMT taking effect, but the AMT calculation would be done when you go to do your taxes the following year. So I don't know if you know the answer. It just occurred to me that I don't know if they're going to use the new AMT calculation for gains that are triggered before June 25th.
That I do not know the answer
That's
to.
a good question.
I mean,
Because
there's a
with
lot
the
of
higher-
stuff where, like, I'm unsure if that's something that I don't know or if it's something that nobody knows yet. I don't know.
It's possible, I guess. I'm just wondering if the higher exemption under the new AMT there, so you're getting capital gains under the old inclusion rate, but potentially AMT calculations on the new AMT rate with the higher exemption. I don't know.
Yeah,
If
so
it screws up the example.
my examples were based on the proposed AMT
Okay.
rules with 173,205 exemption and the higher rate on the net AMT income.
Okay, so just so I'm crystal clear, you're using the 50% inclusion rate today
Yep.
on this capital gain example,
Yep.
but you're using the new proposed AMT rules. Is that right?
Yep. Correct.
Got it.
Because if like the budget proposes this new capital gains rate, but after June 25th, and then it proposes the new AMT for the tax year 2024. So I think looking at it this way does make sense. I'm happy to be corrected on that if someone with more tax expertise thinks otherwise. Yeah. Okay. So keeping in mind how useful deferral can be, even given these rate increases, I think it's important to remember that for long-term investors, realizing large capital gains is not something that you're doing every year. So if we say it's like, if you're not going to realize a gain within 7 years, then you probably don't want to realize it now. Most long-term investors shouldn't be realizing gains, all their gains in such a short period of time. Even someone who's retired living off of their portfolio, maybe they could realize enough gains for the next 3 years of income or something, or 5 years of income, but not the whole portfolio, because even retirees are not triggering all of their taxable gains in a single year to fund their retirement consumption. They're triggering bits and pieces, or none if they're living off of just the distributions from the portfolio.
That's a really interesting point, though, Ben. Sorry to interrupt you, because like I had this conversation with a client the other day, and they do have a large capital gain inside their corporation, and they are essentially retired, right? So to your point, it might not make sense to rip the Band-Aid off the entire capital gain, but because they are generating some capital gains every year inside their corporation to fund their retirement lifestyle, do they then take some number, say 3 to 5 years worth of capital gains within your 7-year break-even threshold, just for the example, trigger them all at once to get ahead of it? It's a bit of a hedge, I guess.
Corporations are different, and we didn't go into that because we'll cover that on a special money scope episode that Mark South and I will do. But corporations are different. So when you realize a gain in a corporation, it creates something called capital dividend account, which can be paid out to a shareholder tax-free. And if someone's living off of their corporation, it means that they're taking taxable dividends out. So there's an interesting planning opportunity with corporations where you may want to realize all of your gains to create CDA. I mean, it depends on what the numbers look like, I guess. But that lets you stop taking taxable dividends out of the corporation for some number of years and live off of tax-free capital dividends. So the break-even math on a corporation for someone who is spending dividends out of their corporation is quite a bit different, because you give up on tax deferral on the capital gain, but you can get a lot of that back by gaining tax deferral on not having to take taxable dividends out personally.
Interesting.
So it's quite a bit different. But again, that's a money scope topic.
That'll be a popular one.
Yeah.
Popular
You guys will love it.
within the group of like 400 people that are interested in this stuff.
I know, but if you're interested, that's the place to go.
Yeah, that's true.
It sure is.
Mark mentioned tax rate risk earlier. I think this really highlights that that's a real thing. We've talked about that on past episodes, that like, hey, tax rates can change. And a change to the capital gains inclusion rate is kind of a big shock to that. Because, tax, it's just a big one-time jump to taxes on assets. We try to do stuff to mitigate this. I mean, we had Scott Cederberg on a while ago talking about how you can optimize RSP and TFSA, although he was talking about the American equivalents, contributions based on hedging future tax rate uncertainty. We don't tend to do that because our clients tend to be in a position to max everything out. But we do other stuff like if someone has a low income year, realizing some capital gains to mop up their low income brackets and increase their adjusted cost base. And that does two things. It reduces tax rate risk, which is what we're potentially seeing now. It also helps to lower the terminal tax bill. So there's a little bit of lifetime tax smoothing by doing stuff like that. And also for people with corporations, again, we'll typically recommend taking some money out of the corporation, at least to fund RSPs, TFSAs, and RESPs. Again, those are just registered savings accounts with tax preferred treatment in Canada. So I think that idea of tax diversification, I know you're big on this too, Mark, just having money in different buckets with different types of tax treatment, it really does protect you against stuff like what we're seeing right now.
Yeah, you end up with a concentration risk, right? And this is, in reality, many people were organizing their affairs this way for decades, right? Where they were using their corporation as a retirement account. And there's nothing wrong with that, as part of the rules. And maybe they were funding some RSPs and TFSAs, but maybe not. And like, I know clients who had done this where they had used their corporation as their primary retirement savings vehicle. They paid themselves only dividends so that they wouldn't have to pay into the Canadian pension plan. And the corporation has now a massive amount of concentration risk from a tax perspective, right? And to your point, tax diversification by using tax-free savings accounts, paying salary to get Canadian pension plan and RSP room, filling up those RSPs, it insulates you from some of these adverse tax changes like the one we're seeing right now. And I have to say, I had an accountant that I work with who I talked with like maybe last year about this. And I was telling him how I'm big on tax diversification. And he was like, no, stuff everything in the holding company. And then the day after the budget, he emailed me. He's like, you were right. Like, I can't believe it, but you were right. And this isn't to say I was right, but this is the exact type of risk we're trying to defend against by using up all these other registered accounts, right? And so there are people, unfortunately, that are going to be disproportionately affected because they didn't take advantage of that in the past. Yep,
exactly. And you can't do it all in 1 year, because to take money out of the corporation, typically you've got to pay personal tax, which means, if you've bled money out of the corporation over time at lower tax rates, great. Now you don't have that concentration risk. But if you decide in this year, I've got $500,000 I want to take out of my corporation, you're going to pay half or more of it in tax.
Yep.
And that's another thing, like on the corporate planning stuff, there are even potentially cases where we would recommend taking money out personally, even if there is not registered account room available to invest in a personal taxable account. It doesn't always make sense, but it can make sense in some cases. And again, it gives you that tax diversification. All right. Is that enough on, what do you think, Cameron? We good on capital gains and AMT?
Oh, it was awesome. It's great material.
There's two other, I think, interesting proposals in the budget that are just worth maybe touching on at a high level. So one is the, the lifetime capital gains exemption. So for business owners selling a business, it has to qualify. There's a number of different restrictions to access the lifetime capital gains exemption. But for those that qualify, the first $1.25 million of gross capital gains would, in theory, be exempt if you sell the shares of the business and you qualify for that exemption. The previous limit was, I think, just over $1 million. It was indexed to inflation, and I believe it just crossed $1 million this year. So the new proposal bumps it up to $1,250,000. It will not be indexed in 2025, and then indexing will resume in 2026. So there are cases when those selling a business decide, or depending on the size of the business, may benefit from that extra rate. And then the last one was the entrepreneur's incentive, which is interesting. This is a brand new proposal. It's not a modification of anything else. And what that does is, up and above that lifetime capital gains exemption of $1.25 million, over the next 10 years, they're proposing to phase this in at $200,000 per year until after 10 years, there's a new $2 million exemption limit above the lifetime capital gains exemption. And within that $2 million band, if you sell a business, the capital gains inclusion rate, instead of being 2/3, will be 1/3. So if you sold your business for $3.25 million 10 years from now, and it qualified, the first $1.25 million would be tax exempt. The next $2 million would be subject to a 1/3 inclusion rate instead of 2/3. So there is, some benefit in those cases.
It's a big deal.
But they excluded a ton of sectors from those that are eligible for that benefit. So financial companies, insurance companies, real estate companies, food and accommodation, many service businesses, any professional corporation, none of those benefit. So I think it's largely, like, if you eliminate all that, I think what you're looking at is like a lot of technology companies or small startups and that type of thing that could benefit from it. It's an interesting proposed change, though, that it has some tax planning implications as well.
As we pivot to the after show, I have to ask you guys, when the budget came out a couple of weeks ago, like, there's so much activity in various parts of the media. Newspapers reached out to you and other outlets reached out. You went to Twitter right away with lots of threads, created the tool. Just tell me where your head was at once it came out, and what's your default go-to activity?
Sure, yeah, I'll start. So I wrote a thread that evening. So the budget proposal came out at, I want to say, 4 p.m. on the Tuesday, I think it was.
Eastern.
And as we were chatting about it, Ben and I and some other advisor and planner friends that we have outside of PWL, and so we were all trying to wrap our head around these changes. And for me, again, my bias being having worked with many physicians, the corporate capital gains issue for me was the biggest issue that I could see from my own experience.
And you saw that right away. It didn't take a while to kind of disseminate through Twitter.
No, I saw it right away just because of the language they used. Like, it was very clear that they said capital gains above $250,000 for individuals and all capital gains in a corporation or a trust. And I reread that line 10, 15 times to make sure that I wasn't missing some language there. And after realizing this is going to impact a lot of people that I don't think realize they are going to be impacted, I decided to write a thread and just walk through the math of it, right? So here's the old rules, here's the new rules, make some assumptions around a capital gain inside your corporation, and you're paying this out to yourself. What is the change in taxes that you're going to pay? And in the example, you're basically paying, a third more in taxes at the end of it for somebody who's taking capital gains in a corporation and then paying themselves out the gains as dividends. So I wrote the thread and I scheduled it for the next morning, I think around 9 o'clock my time in BC. And it got a lot of attention. And it got a lot of attention from physicians. I know the previous head of the Canadian Medical Association, he retweeted that. Obviously, some journalists picked it up. So it was just a frenzy. And what I realized is a lot of people, don't know how capital gains work in the first place. So there's a lot of confusion about that.
Really? Wow.
Yeah, I was having conversations with people that just didn't understand how capital gains worked in the first place. Many thought that business owners could just choose to pay themselves in capital gains instead of salary and dividends. And so they were happy with this tax change because they felt that it made business owners' incomes closer to a regular salaried person's income, because they thought that people who had a business could just choose to pay themselves in capital gains instead. Which, yes, there's things like there were ways to potentially do this in some cases, but that wasn't the point. So my point here is that the spectrum of understanding of taxes is very, very wide in the first place. And then when you get into these tax changes, and then when you get into the changes specifically for how it's going to affect incorporated business owners who have an unrealized capital gain, it gets into some really niche stuff. And it became clear to me that some people just didn't want to understand that, and they just wanted to say good, tax the rich kind of thing. And so there came a point for me where I had to just start ignoring comments on Twitter, because I got direct messages with some really nasty comments and insults, and I'd never experienced that type of vitriol on the internet before, so I had to take a break.
Yeah, it got pretty intense.
It was intense. Yeah.
Wow. And Ben, with the tool, you and Braden met up and started brainstorming this?
Well, my reaction was to start modeling it. First thing I did, and then
That's what you do.
and then Braden
Worst kept
messaged me.
secret.
Braden messaged me to say that he wanted to build an app, and I was like, great, like I've already started modeling it. So I shared what I'd done, and then he turned it into a web app, which was pretty cool. He was off this past week, which was somewhat unfortunate because I wanted him to keep modeling with me. But we were able to get this app out before he left, which was awesome. And then he's back next week or this week when this episode comes out, and we will have done a few modifications to the first iteration of the model, and we'll likely release one for corporations as well. It's a very, very slick tool, and people seem to appreciate it. Yeah,
and then this will be obviously, as you said earlier, brought up in the money scope with our good friend the Looney Doc.
Yeah, so Mark Soth's reaction was similar to mine. He has been also feverishly modeling stuff. I think both of us have logged many, many hours in Excel over the last couple of weeks. But yeah, we'll do a special money scope episode once we both have our heads straight in terms of what people should do. So that'll be coming at some point.
And if anyone is even remotely interested in this topic, the money scope, I know I say this every other week when we're on here, is fantastic. Deep dive, quality conversation around, and you give it the oxygen and time these topics deserve, and it's so well done. And Dr. Mark is so great, with you, of course.
They seem to be appreciating the money scope, which is good. It was quite a venture when Mark and I started it, because we were like putting tons of time into it and hadn't released an episode yet, and we kept saying to each other, like, man, I hope people like this. But they seem to like it so far, so that's good.
That's awesome. You want to jump into the reviews?
Sure.
Maybe Mark, you want to take the first one?
Sure. Yeah.
The one. We only had one.
Yeah. This one's from Guplets50 or Gooplets50 in Australia. Addictive and informative, terribly addictive podcast. The fantastic mix of topics, guests, and breadth of discussion. Not only very useful for beginners, but even for people who have an above average background in finance and personal finance. Canadian investing topics are great because it allows me to immediately compare and contrast with my Australian situation. I have used your work to set our goals, find a financial advisor, and to invest in DFA dimensional funds. If you were in Australia, I would be a client. Keep up the good work. Should we move to Australia? Should we open an Australian branch?
It's not a bad idea. That review makes me feel better about our pretty hardcore Canadian episode today.
Yeah.
I've heard from a bunch of people on LinkedIn, from Christian, who is a fellow Canadian advisor. Hi, Cameron. Your post popped up in my feed that linked to a very useful capital gains calculator your firm created. Just a quick note to thank you and the team for putting together so promptly. Nice to have a tool that advisors and clients can engage with, especially when you're helping them to make seemingly complex decisions. Really enjoy your podcast as well. Cheers. So thanks for that, Christian. Also from Lino, hope you, Ben, and the PWL team, and of course you, Mark, the podcast continue to be absolutely amazing. I genuinely can't describe the impact they have had on my financial journey. Further to our conversations above, since we last spoke, I moved from a boutique firm to a wealth management advising role at a bank in Australia. So we're popular down under. And then I just got one today from Nader in Toronto. Just wanted to reach out and let he wanted to let us know that he is a huge, longtime fan of the podcast and also thanks us for educating Canadians. Ben, you want to do your best at this email? Maybe you can, I've tried to shorten it a bit.
Man, it's a lot of text. Following the 300 episode milestone, I would like to share with you some thoughts as a longtime listener. I started listening to your podcast sometime in 2019 before 4 was replaced with from 2. Remember that? We used to say 4 Canadians, and then we had too many international listeners, and they were like, can you change the introduction because it's going to scare off other international listeners? So then we changed it to from 2 Canadians, and now it's from 3 Canadians. And well before the dedicated theme music. Oh yeah, the new music. Oh man, it's like a history of the podcast.
Taking you back, eh?
Yeah. Boy, have you come a long way. Oh, is that a compliment or an insult? A little bit of both. I'm just joking. Your podcast has helped me a great deal in shaping my own personal investment philosophy. The weekly reminders continue to provide useful, sometimes necessary oversight to stay the course in the face of challenges. To me, the podcast is a treasure of invaluable investing knowledge and a bastion of critical financial thinking. In a world where reason and common sense rarely prevail, your podcast shines a reassuring light through the noise and helps bring focus to long-term goals. Although I'm lucky enough to consider myself mathematically and financially savvy, I can say that sensible investing requires some degree of mindful steadfastness. There is no shortage of temptations or biases, and staying true to one's investment plan can at times be hard work, even for the pros. It is no surprise, therefore, that there are swaths of like-minded people who find the podcast as valuable as I do. I would like to express my heartfelt gratitude for the work you're doing and for providing the service free of charge, making it accessible to anyone with a smartphone. Having followed your journey for half a decade, crazy. I am thrilled to see you go from strength to strength and grateful for everything I have learned. Keep up the good work. Very nice.
We're coming up in 6 years this summer.
Crazy.
That's wild, eh?
Mark, you want to quickly go through this next one, which has been shortened.
Yeah, sure. Yeah. So, hi, Ben, Mark, and Cameron. Thanks for your excellent work on bringing so many interesting personal finance topics on your podcast and YouTube for the benefits of everyone. You are doing really good service. I am an Italian working in Singapore and listen to your podcast every weekend. In your latest episode 299, you bring such a good summary of years of experience and study on investing. I like the multidisciplinary approach you follow when discussing investing topics and improve your understanding of investing, personal finance, behavioral finance, decision-making, psychology, and even philosophy. That is evident from the hosts. I think they meant guests. That's evident from the hosts you bring to the podcast. In this sense, you really nailed it, and I like when you summarize on the most sensible, broad-based advice that can help us investors in navigating personal finance. That's from Marco in Singapore.
Cool. Now, the Mike Green episode, Ben, I mean, wild engagement on that.
Yeah, lots of discussion. I mean, listen, Mike is controversial because he has a theory, and he's very assertive about promoting his theory. I thought it was interesting to learn about. I saw some people say that they wish that we'd pushed back on Mike more, but like I've said this before, people say that when they personally disagree with Mike and they want us to express their opinions to Mike. But like, I don't know if I have enough information to agree or disagree with Mike. Well, either way, like I don't think that what Mike is saying is, factually true. It's a theory. And I definitely want to do more investigating, but we are having, like I've talked to Ralph Coyne about this, and I'll hopefully talk to him again. We've got Valentin Haddad, who Mike references, coming up on the podcast. So we'll be able to ask him about his research and how he thinks about Mike's ideas. We've also got Antoinette Shore, who's written a co-author of another paper that Mike often references on this stuff. She's coming up later this year as well. So, super interesting, but my mind's not made up, and there's more thinking and investigating to do on this topic. But yeah, very lively discussion. If people want to see a lively discussion about very geeky topics, there's one happening ongoing in the Rational Reminder community on this.
I went into watching that episode with a pretty heavy bias because Mike blocked me on Twitter a long time ago, and I've never interacted with him, never. And I just went to somebody quote tweeted one of his tweets to me, and I was like, I can't see this. Who is this guy? And I looked and I was blocked. I of course knew who he was, but I was like, I've never engaged with him. Why did he block me? And I think it's just because I talk about index funds so much. He's just like this clown and just blocked me without even interacting with me. So I went into that episode going okay, this guy who doesn't like me, I'm going to go watch this episode. And I have to admit, it was a really, really fascinating episode. He's
right.
clearly brilliant.
Yeah.
I had to slow it down and go back and watch a couple segments a couple of times because his level of knowledge just far exceeds my own. But it was a really good episode and a very eye opening because it's not a perspective that I had considered before. So very good.
No, and I didn't get it before. Like I had made 2 videos because people would send me Mike Green stuff. Like, what do you think about index funds breaking the market, whatever? So I made 2 videos about market efficiency and whether index funds are breaking market efficiency. And Mike saw one of those videos, and that's kind of what led to him coming on for an episode. Is he got super upset about my video, wrote a whole post about it on his Substack, which was unnecessarily mean. But anyway, I read that post and sent him a message. I was like, listen, Mike, if you have such a strong opinion, why don't you come tell us about it? And then in preparing for it, I actually went and read his stuff and understood that he was not, in fact, talking about market efficiency at all, which then helped me understand why he was so upset, because I think everyone dismisses him for the same reason, and it's not even what he's talking about anyway. It was an interesting, end-to-end interesting experience. I think I enjoyed it. The cool thing just happened while we were talking here, while we've been recording. The wealthy barber, David Chilton, who in Canada is a very well-known figure in personal finance. He wrote a popular book. Like
way
the
beyond
book.
Canada. He's huge in the U.S. too.
Oh, I didn't actually even realize that. I knew
yeah,
he was very famous in Canada.
I think he was one of the leading, back in the day, one of the leading fundraisers for PBS, if I'm not mistaken. He was very popular in the U.S.
Okay, I didn't know that. So David Chilton, the wealthy barber, that sounds like more people than I expected will know who he is. I got a notification on my phone as we were sitting here on my YouTube channel on the most important lessons in investing video that listeners may have seen, or they at least heard us talk about that topic on Rational Reminder. He commented, "Hey Ben, it's Dave Chilton, the wealthy barber." Yes, Dave, I know who you are. I enjoy your videos and podcast, especially this one. You're well informed and very genuine. It's clear you really want to help people. Well done. That's pretty cool.
I saw some tweets today that he has a new service coming out to help people.
So I just saw the headline. I didn't see what the service is all about.
I just saw the headline as well and looked at it. It just came through. Yeah, we invited him on and he was unable to join us. So,
well, I'm going to reply to his YouTube comment and tell him to DM me on Twitter, and we'll see where that goes.
Nice. High praise indeed.
Had a few people asking about meetups, so hopefully this fall we can get you to town, Mark, because I think there's a good chance that our very good friend and soon to be your co-author, I guess, Dan Solon, could be in town. What's that?
Why would Mark come here? Why don't we go to BC?
That's actually not a bad idea, but Dan may be coming to Ottawa. That's all. That's a chance, so it'd be cool to do it. But no reason why we can't go to BC anyways.
Yeah,
we've never had a BC meetup. That's actually a very good idea.
Why wouldn't Dan want to go to BC also?
Well, that's also a very good question. We can pose that to him. Anyways, in the fall, somewhere in Canada, we're hoping to have a meetup with us and
somewhere in Canada
and Dan. So we'll pin that down.
Nice.
One end or the other, one side or the other, somewhere in the country. We'll be there.
So Mark, it's today we're recording this May 1st. How's the book coming?
Yeah, good. I'm about I'd say a quarter of the way through. So the book itself, and I'm just measuring that by chapter count. So the book itself has about ballpark 40 chapters, and I finished off chapter 10 yesterday. It's really interesting because, as you guys know, Dan is a huge proponent of an evidence-based approach to everything. And so his book has, I don't know how many hundreds of references to surveys and studies and everything else. And he basically never makes a point unless he can back it up with some kind of reference and study, which is awesome. The problem I'm finding is that there aren't necessarily analogs to a lot of these studies in Canada, right? Like the US just has such incredible data. Things like, just yesterday I was writing a chapter on debt and spending specifically for millennials. And the points he's making, I'm in some cases having difficulty finding a correlation in Canada that I can back it up with. So a lot of the time being spent on the book is really just looking to see if I can actually find analogous data for what he's saying in the US to see if it exists in Canada. But it's great. I'm enjoying the process. Dan's a great writer. I think the book's going to be quite popular, and I'm really hoping to get it written, at least the first draft of them, by the end of this month. It's now May 1st. So
love it. Speaking of evidence-based, we have an upcoming webinar on May 22nd at noon Eastern Time. Compensation strategies for Canadian business owners. We've done a bunch of webinars in the past. This one will be co-hosted by our colleague Brady Plunkett, who's a portfolio manager here at PWL, and also Spencer Brooks, who's a partner at Henry Warren, which is an Ottawa-based tax and accounting firm, for a presentation on an evidence-based approach to business owner compensation techniques. So we'll have the link in the show notes to register for that. That's May 22nd at noon.
Phenomenal. all three of them. Brady's great. Spencer and Jacob. Was Jacob's name in there? Oh, it was just Spencer.
Just Spencer.
Spencer and Jacob at Henry Warren. They helped us on one of the Money Scope episodes on this same topic on corporate compensation strategies, because Mark Soth and I, we were kind of looking at each other like we know enough about this stuff to say what we're saying, but like we should probably have someone check it, because
Who's credentialed in tax?
really complicated. Yeah, someone with actual expertise. And so Spencer and Jacob, they both contributed to reviewing that episode, and their input was just incredible.
Yeah.
Like the little stuff they pick up, like this is technically correct, but it would be more technically correct to say this. And Mark and I were just like, man, this is crazy. But those guys are super knowledgeable on tax.
Insanely good firm. As always, connect with us all over the place. Twitter, LinkedIn, easy to reach, easy to connect with. Please leave a review. Guys, any final thoughts?
No, I'd love to see some more reviews. We're the total number of views is getting pretty high. I like watching that number go up.
It's closing in on 1,200, I believe.
Yeah. So if you're enjoying the show, leave us a review. Or if you're not, have we ever had bad reviews? Maybe a couple.
Yeah, a couple in there.
We'll take anything we can get.
Yeah. All right. As always, thanks for listening.